Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. This is episode 37, and buckle up, because today we're diving headfirst into the choppy waters of the U.S. tariff wars and what they mean for your real estate investments right now in early April 2025. I know you're sick of news about the new tariff policies already, but the ripple effects are already hitting the market. We've talked a lot about understanding the big picture, from the importance of research, episode 16, to the affordability crisis, episode 30, and even the slowdown in housing starts, episode 31. Tariffs are another major force shaking up that picture, adding a layer of complexity and, yes, risk, but also potential opportunity. So, what would a smart investor do? We're going to break down the immediate impacts, give you our top 5 predictions based on the latest data, and offer actionable strategies. Let's get into it. First, a quick refresher. Tariffs are essentially taxes imposed on imported goods. When we talk about real estate, we're particularly concerned about tariffs on key building materials. Think lumber, a lot comes from Canada, steel, gypsum, used in drywall, often from Mexico, and even appliances, often sourced from China. Why should you care? It's simple. 1. Increased construction costs. When tariffs make imported materials more expensive, the cost of building or renovating goes up. Builders often have to pass these costs along. 2. Impact on housing supply. Higher costs can discourage builders from starting new projects, potentially worsening the inventory shortage we discussed back in episode 31. 3. Economic ripples. Tariffs can lead to trade disputes, affect inflation, influence interest rates, and impact overall economic confidence, all of which directly influence the real estate market. Now, here's prediction number 1, short-term construction cost surge. Our first prediction was that tariffs would drive up construction costs. Update. It's happening faster and more intensely than expected. Just in the last few days following the new tariff announcements, lumber prices have reportedly surged 15%. That's a sharp jump. This pushes the estimated additional cost per new single-family home closer to $10,000 or even $12,000, up from earlier estimates. Direct tariff impact plus ongoing supply chain sensitivities are amplifying the effect. If you're developing or flipping properties right now, you need to revisit your budgets immediately. Factor in these higher material costs, or your profit margins could evaporate quickly. For those holding existing properties, particularly rentals, this could indirectly boost demand as buyers get sticker shock from even pricier new builds. Now, prediction number 2 was that pricier new homes, combined with already challenging affordability, like we discussed in episode 30, would push more potential buyers into the rental market. And that's exactly what seems to be playing out. Reports from the past week suggest rental vacancy rates in many major metro areas have dipped by about 0.5%, signaling tighter competition for available rentals. Because it's simple math. If buying becomes even more expensive, people rent for longer. If you're a landlord, this increased demand is likely good news in the short term. You can expect higher occupancy rates and potentially have room for moderate rent increases, especially in desirable areas. Consider offering longer leases now to lock in good tenants while demand is strong. But while short-term rentals might get a boost, the broader economic picture, prediction number 3, is looking a bit cloudier. Our third prediction was that tariffs could slow overall economic growth, eventually putting downward pressure on real estate values. Update. The economic reaction seems to be happening faster than anticipated. Global markets got seriously spooked by the recent tariff news, with major stock indices like the S&P 500 and NASDAQ having some of their worst days since 2020 just a few days ago. Reflecting this uncertainty, the Federal Reserve has reportedly already trimmed its 2025 GDP growth forecast down to 1.8%. This is a warning sign. If you're invested heavily in markets reliant on manufacturing or agriculture, sectors often hit hard by tariffs. Be prepared for potentially slower appreciation or even price dips as buyer confidence wanes. Commercial properties, especially office spaces, might also feel the pinch if businesses tighten their belts. Diversification across different economic regions becomes even more important. Now, this economic pressure isn't hitting everywhere equally, which brings us to prediction number 4 here. Prediction 4 was that local economic resilience would create significant regional differences in real estate performance. We are seeing this right now. In just the past few days, we've seen reports indicating home prices in some tariff-sensitive Midwest manufacturing areas softening, maybe down 2% month over month, while tech hubs like San Francisco, with more diversified economies, are holding relatively stable. Because regions heavily dependent on industries directly impacted by tariffs are feeling the pain first. Areas with diverse job markets are better insulated. This reinforces what we discussed last episodes. Hyperlocal knowledge is everything. In potentially vulnerable markets, focusing on stable rental income might be wiser than banking on appreciation. You might even consider selling assets in those areas before prices potentially slide further. In resilient areas, holding steady might be the best strategy. Your local market research is non-negotiable. That said, it's not all defensive maneuvering. There's a potential long-term offensive play, which is prediction number 5 here. Our final prediction was that tariffs, while causing short-term pain, could encourage more domestic manufacturing over the long term, boosting demand for industrial real estate. And we're already seeing early signs. Reports indicate industrial lease signings jumped about 10% last quarter, especially in the Southeast, as companies explore onshoring or bringing supply chains closer to home. This is the end game, at least how it's planned out. Tariffs make importing more expensive, incentivizing companies to produce goods domestically. This drives demand for warehouses, distribution centers, and manufacturing facilities. Industrial real estate could be a very smart long-term play. This trend is likely just beginning, so getting in relatively early in emerging industrial hotspots could yield significant returns down the road. It requires patience and careful market selection, but the potential is there. All right, let's recap the situation as of early April 2025. These new tariffs are creating immediate impacts. Construction costs are spiking, prediction 1, and rental demand is getting a short-term boost, prediction 2. Looking mid-term, the risk of a broader economic slowdown seems more pronounced, prediction 3, which is already creating regional winners and losers in the housing market, prediction 4. However, there's a potential long-term silver lining for investors focused on the rise of domestic manufacturing and industrial real estate, prediction 5. Now here's your challenge. I want you to think about your specific real estate situation or target market. How might these new tariffs impact you? If you're planning a renovation, research the latest lumber or appliance costs. If you own rentals, check the current vacancy rates in your area. If you're looking to buy, analyze the economic base of your target region. Is it heavily reliant on industries affected by tariffs? Take one step this week to assess your specific exposure to these tariff wars. And, as always, if you found this episode valuable, please subscribe to the 5-Minute Prime podcast, share it with fellow investors, and leave us a review. Knowledge is crucial in times like these. You can find more resources, analysis, and tools at reiprime.com.